Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. As always, we need to go over some important housekeeping details about the session, and then I'll introduce Rob. For those of us that have been around, this is nothing new, but for anyone that might be joining us for the first time this evening, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there. Or certainly feel free to take a screenshot of it if you like, but that's the main point to take away. So for this session, we are live streaming to multiple different platforms. Rob's going to go through his general 45-minute presentation, go through some case study considerations, and then with the time remaining, we'll take a combination of questions from all of the platforms that we are live streaming to. So keeping that in mind, the Q&A portion will be limited. We're definitely not going to get through every question. We never do. So if we don't get to your question, just know it has nothing to do with the validity. We just only have so much time for this session, and they're completely selected at random. If we don't get to your question, you should take that as encouragement to attend the Insiders meeting, which takes place every Thursday evening, and that's for paid subscribers only, where Rob does a 45-minute Q&A portion after his presentation. So obviously a much higher likelihood of getting your question addressed in that session if we don't get to it this evening. As you'll see circled on the screen, it's just going to be the Q&A and questions in written form, rather. We're not going to do any voice questions, again, with the limited time for this session. And lastly, for the chat window, I can handle any support-related queries in there. And of course, for any interaction amongst other attendees, please feel encouraged to use that window. Just make note that by default for our Zoom audience, it goes to hosts and panelists. So if you would like everyone on the webinar to see your message, be sure to change that to at the bottom to everyone instead of hosts and panelists. Lastly, Rob will only take questions at random from the Q&A window. So if you want your question potentially addressed from Rob, please be sure to write it in the Q&A window and not the chat. All right, that covers off all the important housekeeping details per usual. And it seems like the market's still continuing to digest the rate hike predictions from the Fed. So interested to hear Rob's thoughts on that, and very much looking forward to interacting with you all. So thank you for joining us for this live session. At this moment in time, I'll introduce who we're all here for, man of the hour, and that's Rob Roy.
Hi, everyone. Welcome to this week's TradeFinder Live, and thanks, Zach. We will take a look at the market because it is in a little bit of a state of flux at the moment, and I think it is exactly as Zach said, trying to figure out how to calculate moving the rate cut into next year. Kind of seems to keep sliding along a little bit. How many more rate hikes are there going to be? So we've gone to a point where the market felt pretty comfortable on where things were going into this bit of a state of flux of we're not really sure. We're not really sure how many more rate hikes are going to be. Not really sure how far they'll have to go before turning around and cutting rates. So it did throw a bit of a monkey wrench, if you will, into the markets. And if you take a look at the chart of the S&P, you can see we have a perfect 50% wave 4 correction there on the S&P. So even though it feels like all of the upward momentum has stalled, and it did a bit, we had this triangle that we were talking about, even though it was a small one, had a pretty decent breakout out of this small triangle and came down about where you would expect it to go, and have found support right there, again, at the 50% wave 4 correction. So even though it hasn't felt so good as far as being bullish, if you're being bullish, really from a technical standpoint, it's not that bad. The negatives are we are below the 10 and 50-day moving averages. We just had a negative 1030 cross. So none of those are positive. But with this wave 4 right at 50%, it's a good spot that if the market does want to turn and move back to the upside, this is a place where it could do that. So when you look at the chart, it really doesn't look that bad. We know that we go through impulses and corrections. I mean, this is really the gist of Elliott wave right here. And I'm leaving out the wave 2, but it's there, kind of focusing on the zigzag type mentality here. But you can see that impulse correction, that's all part of how the market moves. And it's what Elliott wave excels at is trying to determine how far those corrective moves are going to go, how far the impulse moves are going to go. It takes all that stuff into account. So from a general standpoint, we're not so bad. And we've been talking on the previous weeks, based on the Q&A, et cetera, we could even come down to 380 and still technically be okay. That would likely be awfully close to disqualifying this 5-wave impulse pattern to the upside, if not fully disqualifying it. But there's a lot of support there at 380. So could we go down here? We could. If we were to break 380, then everything changes. Then I think we have to really relook at all of the potential moves in the market. But for now, we still have this big zigzag pattern intact. It hasn't been violated, still with that 5-wave target there. And then if we look at this zigzag pattern that we talked about, could be a complex C wave in the bigger zigzag, still everything coinciding right there at the wave 5. So none of that has changed. There was a comment on the last weekend's update on YouTube of why do the Elliott wave charts constantly change? And I don't know that they really constantly change. It hasn't really changed for a few weeks from what we've been showing, even with the market coming to the downside. The charts have all basically been the same. But when we really analyze it, I think that's what makes Elliott wave so great. The markets are dynamic, they're not static. And so the markets move and the markets change. And a lot of indicators that are lagging indicators take a while to readjust when the market does move or when the market changes course a little bit. But Elliott wave is really quick to adapt to it, and the patterns are really quick to change. And I think, again, that's one of the positive aspects of Elliott wave, not just the fact that it is measuring impulses and corrections. And if you don't believe the market moves in impulses and corrections, then Elliott wave is not going to be an indicator for you. But if you do believe that, then if you're not looking at it wholeheartedly, I think you should. But also take in the fact that it's probably the quickest of all indicators to adjust when the market makes a bit of a change. So I've talked a lot, and really the charts aren't much different at all, other than the wave 4 has come down a little bit from last week, but the overall pattern's the same. The zigzags are the same. None of that has really changed. So again, we move down to 380. We'll have to see if that disqualifies the pattern. It might. If we break 380, then definitely all bets are off. And now we're starting to think about new lows. But we're not there yet. We're not even really close to that yet. So I think the market is just, again, discounting the fact that the Fed fund futures has changed. The forecast of what the Fed's going to do has changed. So this has to do with the Federal Reserve and how much liquidity they're going to take out, how many rate hikes they're going to add in, more than it has to do with anything else. So anyway, wanted to share that with you. Let's take a look at the VIX before we go look at anything else. And interestingly enough, on the VIX, again, a bit of a move to the downside from that breakout of the triangle, but no real move to the upside in the VIX. We had a little bit of a bounce initially, and since then, we've actually been kind of coming down. So the VIX is not concerned about what's going on, or at least it's revealing that there's not a lot of fear in the market for what's going on. So coming down, are we going to make it down to 18? If you're bullish, the negative here is you don't want to see the VIX coming down when the market's coming down. You would rather see the VIX coming down when the market's going to the upside. And we're using up some of that collateral that we have here on having a higher VIX, with it coming back down towards 18, where we could be having a run to the upside in the market. So we are giving up some of that. I would say that's a negative as far as where we go. It's only so low that the VIX is going to go. I know it could go to 0, but it isn't going to go to 0. It's probably not going to go below 10. It's likely not going to go below 18 unless we have some sort of a spectacular rally. So there's a limited amount lower that we can go on the VIX and have any sort of a significant rally from here. So that, to me, I think is a bit of a concern. So I wanted to share that with you. All right, so let's take a look at interest rates, which have calmed down from this run to the upside here. And as you note, the Elliott wave chart has relabeled, and people are looking at that like the Elliott wave chart has changed. And let's just go back and remember that what happened here was the market, or at least in this case, the TNX, did exactly what it was supposed to do. And you had this wave 5 that finished. You're supposed to go back to the previous 4. We did. And so once we did that, now the algorithm is trying to figure out what's the next likely move, and it doesn't know. So there's nothing labeled here. I take the ABCs off. There'd be ABCs because this is a wave impulse here. But is it an A wave impulse of a flat, a zigzag, or a triangle? It could be any of those 3 corrective patterns, which is usually what happens. We finish the 5, we go back to the 4, and then we go into a corrective mode. It will tell us once it knows, but for now, it's trying to figure it out itself. And that's when you start to, and that's one of the things that I wanted to share with you, is the fact that the market is trying to figure out where things are going to go. And this is one of those points we've not been super active on our alert service because of this. And I think we're in another period. We had been quiet, then we got active, and now we're kind of quiet again. And that all plays into don't guess. Let the market wait and tell us where things are going to go from here. So even with that 50% correction here, as you know, we could come down to 61.8, which is not a negative thing at all. In fact, I think that's a very positive, because I really like the 61.8% corrective level within Fibonacci. And if we got to that, we could take some shots to the upside if we had patterns that were set up. And if we break that, then we change. But it's a good point to try to see where things go from here. So now let's take a look at the dollar. And the dollar is doing extremely well. Not rushing back to the upside, just kind of slowly making its trek. And it's going to do the same exact thing that TNX did. Once we get back to this previous 4, this 5-wave pattern will go away. And if it hasn't moved within the algorithm of what's next, it's going to be searching as well, just like it is with the TNX. You can see we're almost there. We haven't quite gotten back to that previous 4, but almost. So once that happens, again, doing what it's supposed to do, the algorithm will try to figure it out. I just don't want to see, and we do have some really good resistance through here, even if we are able to violate the previous 4 on the dollar. There's some resistance through there around 106.5. I don't want to see the dollar break above 107 again, because if it does, you can see that we had this pretty vertical move lower, and that means there's no resistance in the way. If we break above 107, then the dollar could start running again. That's challenging, as you know, for international companies with the exchange rate, et cetera. So we don't want to see rates take off. We don't want to see the dollar take off. We want things to kind of stay status quo here. I would prefer to see the market moving to the upside with the VIX coming down, but that's really the only main negative here. Other than that, things are pretty much okay as far as the potential to go higher from here. So in no way, shape, or form is it, doom and gloom, and all the good stuff that we had done is over with. We're just going through a corrective phase, and it could be, if the patterns hold, extremely constructive of what we're doing here. You don't want to see things go straight one direction, because those are the moves that tend not to hold. So we'll see what happens over the next week. But for now, it's not that bad, even though it kind of feels like it when you're watching the market each day. Looking at the diamonds, so we did get that break to the downside out of this triangle. And in Thursday night's insiders meeting, if you were with us for our subscribers only meeting that we do every Thursday night, Jeff had mentioned that he kind of looks at this as more of a big descending triangle here, with the 330 area as potential support, and that we could bounce around in this area for a while here. And I don't know, perhaps you want to even move this down here on the horizontal trend line. So whether you want to look at it from a symmetrical triangle or a descending triangle, it wouldn't matter on whether or not we've had a breakout or not. If we hold here and bounce up, and we'll find out in a couple of weeks which one is correct. If we break this level here, there it is, Zach. That's a Katie bar the door setup right there. Because if we can't hold this support level, there's absolutely nothing in the way on the diamonds for the downside. We would likely come down here towards 290. That is a distinct possibility because it was such a run to the upside in October. But we have to break this area here, and this wave 4 is at 50% as well. So isn't it interesting now that even though the charts don't quite look the same, we have very similar Elliott wave patterns now in the S&P and the Dow. Both of them in a 5-wave impulse pattern to the upside, both with wave 4 corrections right at 50%. Pretty interesting because we haven't had that in a while. Remember, wasn't that long ago when we had 3 different Elliott wave patterns between the S&P, the Dow, and the Qs? We're kind of all coming in line here with these markets now. And take a look at the Qs. Not quite the 50% correction. They're outperforming slightly, which we thought they would as the Fed neared the end of their rate hike cycle. We said they would underperform while they're raising rates. They should outperform when that goes to when it comes to an end. And it's debatable about when it's going to end. That's what the market's trying to figure out. So we have a 43% corrective move in the wave 4 on the Qs. But you could argue that all of a sudden, where we had not that long ago 3 distinctively different Elliott wave patterns of the 3 major markets, and now they're all almost exactly in agreement. We talked about that in the past, that when it gets into discombobulation like that, I call it usually doesn't last very long. They usually kind of come back into some sort of semblance of normalcy, and that's kind of what's happened. Let's see what the IWM is looking like. That we broke above 190, we broke back below 190, and geez, we're trying to hold there. Look at that, wave 4, 43%. Do you remember what I just showed you on the Qs? Let me bring it back if you don't remember. So 43%. So now we could argue the Dow, the S&P, the Qs, and the IWM are all pretty much in line, where we have the S&P and the Dow with the exact same wave 4 correction, and we have the Qs and the IWM with the exact same correction. And those 2 are viewed as being more risk on, small caps, technology, and they haven't corrected quite as much. So they're slightly, ever so slightly, I will admit that, outperforming. Again, nothing doom and gloom here as far as the markets, even though this is given an opportunity for a lot of the doom and gloomers. And, that really seems to work well marketing. I don't know why we tend to want to be negative like that, but when you put stuff out there that's doom and gloom, it tends to attract more attention than, hey, everything is great and we're moving forward. Nobody seems to care about that. It's really a weird state of mentality. But I think this is pretty impressive with where the markets are in their Elliott wave patterns. I mean, really, it's pretty amazing. All right, so let's see what we can find out here with old Bitcoin. We did that, tried that move to the upside above 24,000, and we're trying to see, could it get above there? And it didn't. It gave it a go, but it couldn't hold it. There was never a follow through day. Notice that. And so here we are back, but holding in there pretty well, honestly. The negative is we're slightly below the 10-day moving average. That means that there is a possibility that we come down to the 50-day moving average, that we come back down potentially all the way to test 20,000. That's all in the cards. We've got a wave 4 that's getting close to that 38.2% fib level. Is that 24? Let me take these off. That's 20. So it's the 23.6% correction. So remember, Elliott doesn't even view that as a corrective mode. He views that as a continuation of the impulse. So if Elliott was looking at this, he would say, yeah, we've got some corrective moves here. We're still in a big impulse. to the upside. If we can get back above 24,000, that needs to happen fairly quickly. The longer we hang here, the greater the chance of moving down. But look at this with the consolidation that occurred back in January and February here around 23, 24. So we'd go up to 24 and come down to 23, but held in there pretty well. We had one little dip down and turn around and got it right back. Can we hold that level right now and move back to the upside? If so, look where the wave 5 is. Check that out. Dead on that 28,000 that we've been talking about as far as the next move. If Bitcoin can continue higher, those 4,000 block moves that it had on the way down, we have the 4,000 block moves on the way back to the upside. So 28,000 is very well in possibility if we hold right here at the 23,000 and get back above 24. So there's two things that have to occur there, I think, for 28,000 to show up in the near future. Hold 23, get back above 24, and then we'll be okay. Let's look at the Aussie market. We had broken that important level that it needed to hold and said that, okay, so it was going down to the next one, which is 23, and look where we are here. So this is yikes. We really need to hold here. This is kind of a pretty organized move to the downside, just really a march lower. But for the last 3 days, we've held in there right at 23. If we can hold there, you can see we're a tiny bit oversold from the 10-day moving average. If we can hold there and turn back to the upside, again, no harm, no foul. We have to take into account, however, that could be the end of that wave 5 and that we're marching back to this previous 4, which means that 23 doesn't hold and we come down to 22. That's very, very possible on the EWA. If it holds here, turns back to the upside, there's a chance the wave 5 isn't finished yet, but that's a pretty good move down. And for me, from what I've been sharing, I felt like if that was going to be the case, we should have held that wave 3 high. So coming back down towards 24, I didn't think that was a big deal at all. If we could have held there and turned to move back to the upside, then perhaps we had a continuation of the wave 5. But the fact that that previous 3 level there at 24 didn't hold and we're down at 23, I think that if you were putting odds on things, the odds are greater that we do make a move down to 22 rather than holding here at 23 and making a new wave 5 high. But there's enough support there that it could hold. I just think that that possibility is a bit lower than continuing back to the downside. Could that coincide with our markets moving down to the 61.8% levels? It could. Then everything would be lining up if that happened. If these international markets move down to their levels and our markets move down to 61.8% wave 4s, I think everything would be in agreement then. And so here we are with Canada, the EWC. It's doing its best to hold here at 34, tried to break it, no follow through, jump back to the upside, but so similar in charts to the EWA in the Aussie market. I think that same scenario applies here. The possibility of holding 34 and moving back exists. We didn't hold the previous 3 high, and I think the higher probability is that we do come back down here, maybe not even just to 33, but perhaps back to the previous 4 there at 32. But if it can hold 34 in turn, then maybe we can extend the wave 5s. Looking at the India market, the INDA, which had all of its problems and all of the headlines, and there we are. We went down to that 39 level. Now look what's happened. Because we hit 39, now we're getting a new potential level down around 38. Is that going to be the next move? So 39 came into play. Instead of it didn't hold 40, we'd go to 39. Didn't hold 40, went to 39. We were talking about that Thursday night as well. And Jeff had said he felt like 39 was coming, and it did. So here we are right at that previous wave 5 low. Look at that, exactly at that low. If we're going to hold, this would be a very likely point for it to hold because we are testing that wave 5 low from June. We are still a little bit oversold. maybe we can turn and move back to the upside. But gosh, just one big negative headline in the news just seemed to tear everything apart with the INDA, which was arguably one of the better performing international markets. The INDA, along with recently, but not over the past couple of years, as you know, but recently, the EWG in Germany, we did come test that 50-day moving average, bounce back up. I think this is in danger here of coming down to test that previous wave 3 high at 26 if we don't get right back above that 10-day moving average. So here we are. This is where the rubber meets the road on the EWG. We tested the 50-day moving average. We bounced up. We were not able to get above the 10-day moving average yet. But if we can turn and get back above it, then you want to say, okay, back above the 10-day moving average is great. But really, if we're going to do anything significant to the upside, we got to get back above 28 as well. So this two-step process here. Recover the 10-day moving average and then follow through with getting above 28. If we can do that, then perhaps we have something further to go with the EWG. Or are we going to be talking about in the next few weeks? Well, the EWG so underperformed for what, 2 years? Over a year, near 2 years, if we go back and add it up, and it's had a little bit of a period of outperformance here. Is that the end of it? And then we're going to go back to where we were. It's possible. So really, even though we're looking for information from not just the U.S. primary markets, but some of these other international markets, we're looking for that on an even shorter term basis here on the EWG. The next couple of days is extremely important if we're going to be able to turn and get back above 28. If not, again, I think 26 is what happens with the EWG. All right, I wanted to share a couple of things with you here on our trade alert service that we have at ewotrader.com. As you can see, this was a position on CPRI. It was a calendar spread, not a big return here, but a small one. And I also wanted to show you something that is kind of frustrating as far as where we are in the markets right now. And this is something that we're all dealing with in the world of trading options. And I mentioned our subscribers are aware of this. We've talked about it. We've talked about it on YouTube. A lot of people on YouTube have talked about it on the fact that it's been a challenging market. If you listen to the financial networks, a lot of long-term traders, people have been around a long time, said last year was one of the most difficult years they'd ever seen. 2021 certainly wasn't easy either. But take a look at this, right? So we entered this UNG position on February 7th. So let's bring up UNG and go back and look at February 7th. So this was an alert that went out. Remember, we were talking about how I felt like UNG had bottomed and we were going to move back to the upside. So if we go back and look at February 7th, so that was the date. This is one of the really cool things about this software too. See these feet? I know a lot of programs you can go back and look, but this one's so easy. You just click on the feet and then the dates there at the bottom. You want to go back. Okay, where were we on February 7th? Boom. Easy enough. Back to February 7th. So here's where we were. And the high of the day was 892. So 892 is the high. Hasn't been that long ago. Look at where the high was today, 916, a new high. Well, we bought calls. So clearly those calls are doing better. We're making money, right? No. And these are June options. So it's not like time decay is affecting these. So we've had a week or so, 2 weeks, 3 weeks of time decay, but they're June options. So they're not April, they're not May, they're June options. So you know what the time decay curve looks like. Time decay should not be affecting these yet. We are now higher in price than we were when we sent out the alert to buy these calls. And you take a look at it and we're down 21%. How is that possible? How can the stock or the market or the security be higher than where it was You bought an option that makes money as the market goes to the upside. And not only are you not making money, we're underwater in this position right now. And that's what really is really frustrating. And so a comment might be, well, the VIX, volatility was clearly much higher when you put that on. All right, well, let's take a look at the VIX and see where it was back on February 7th and see if it's volatility that's come out. That's where the VIX was when that alert was sent out. It closed at 1866. And where the VIX closed today, 20.7, 2 full points on the VIX. So volatility is higher than where it was when we sent that alert out. You see how challenging it is in the market right now? So how do you handle that? Well, one of the ways is to put spreads on, which, limits your potential upside. Kind of try to avoid that if we can. But if you don't have a choice, then that's what you have to do, is you put on a spread, or you have to add to the position, make adjustments. And we do a lot of adjustments at EWOtrader.com. Some people love them. Some people aren't big fans of it, think there's ulterior motives. No, what we're trying to do is offset what's going on. So if we felt like UNG was going to go higher before, and now we're higher than where we were, would it not make sense to, while the options are cheaper, perhaps add to the position? So we didn't know when it came down here, but moving back to the upside and back above where we were when we got in, we're well above the 10-day moving average. So several days we've trended above it. I don't think the 30-day moving average is going to act as much resistance. I think very likely that we move back to the 50-day moving average, and then we'll see. I felt like the longer term move on UNG was eventually, I don't know that we go much past 15 to the upside, but I felt like we were so oversold that we could potentially get there. That wasn't the original goal, but I feel like that's where we could go. But an adjustment to make here is, you've been right. We've been 100% right, even though we had 2 days where it went the other way before it turned and went back to the upside. But overall, we're right and we're losing money. Difficult scenario. You have to know how to handle that. And if you're experiencing that in your own trading and you want to follow along with us in our adjustments, again, EWOtrader.com, I'd love to have you. But I just wanted to share that with you on how frustrating that is for the average trader. And then you get all the stuff in the market is manipulated and all these kind of things. And who knows what the regular reason is, but I just discounted the ones that are primary, with time decay and volatility are the two main reasons that long options lose value. We're not experiencing time decay. We're too far out in time to have that. We're not experiencing a drop in volatility. So you can see there's probably a little bit of a drop in volatility on UNG. And so you can see there's a little bit of a drop right there, but not much, but a little bit. And that's where the market makers are going to go and utilize it. It puts a lot of pressure on you. Not only have to be right, but you have to be right in a relatively short period of time to be an options trader. It's just the pressure. That's the pressure of being an options trader. We have all these wonderful things where we have leverage in our favor. We can control risk far greater than you can in buying stock, I would argue. A lot of people don't believe that, feel differently, but that's because they don't fully understand options. But there is a time constraint on there. And even when you try to take that out of the equation by going further out in time to avoid the time decay, you can see there's still these things. So you have to adjust for them. And there are ways to adjust. It's not like we just have to sit back and say, well, that just sucks and take it. No, you can turn the tables. So we can sell premium. We can turn that into a spread by selling a premium on a higher strike. Or we can simply dollar cost average down by adding more calls. And the way you do that is by, how's the premium look? Where are you getting the better benefit? Are you getting a better benefit by selling a higher strike call and turning it into a spread? Or are you getting a better benefit from buying more calls because they're cheaper than they were when you bought them, even though the market's higher? interesting stuff, isn't it? I mean, that's the challenge of trading options. And when people ask about this, I just, we're in a different world now. We don't have all the people on the floor so much anymore. So much is electronic. And you have to change with the times. You have to be able to adapt and move forward with what's going on. Otherwise, the market can chew you up and spit you out, even when you feel like you're not doing a very bad job of picking direction and getting moves right, and yet you're still losing money. That's a frustrating state of being. Don't just sit back and take that. That's the market winning, right? So make the adjustments, do what's necessary to counteract things that are going on. Well, anyway, that's my soapbox speech for tonight. I wanted to get that out of the way. So let's hurry up. I'm going to use up all our time. Going back to February 7th, we had the Google and Apple. And this was the morning of the 8th where we had the big move to the downside. We do have a current alert on Google for our alert subscribers. Barely. We're hanging on. We talked about this Thursday night in our insiders meeting. As long as we can hold 90 here, we will stay with this. But if we break this 90 area and start to head lower, we will either get out of the Google long or we will potentially look short, but there's not a whole lot of room to the downside. There's going to be pretty good support there around 85. So there's not a lot of risk moving there, and there's not a lot of potential gain to flip that and go short. So it would probably just be close the position, take a small loss and move on. With Apple, and so same time frame here with Apple, and here's where we are now. Hanging in there pretty well, honestly. I mean, Apple's has done a pretty good job. You can see the 10 and 50-day moving average are converging on each other, and we're hanging right in that area. We're in an area of a lot of congestion from support right through there. So, I think Apple looks pretty good. Now, the negative is we're in a qualified 5-wave to the downside pattern. Barely. It wouldn't take much to disqualify this to the upside, which is one of the reasons we're hanging in there. But if we do break this 145 level, changes everything, I think, with Apple. But you give it a chance. As long as you could even be a little more lenient and say, as long as it stays above 140, I'm okay with our long position. But if it breaks 140, you got to get out, because then 130 comes in a very short period of time. But if you wanted to be a little more conservative, you could say, I'll hang in there with that 50-day moving average at 145. If we stay in there, I'm okay. But we break that, I'm out. And then, holy cow, MPWR moving all over the place here, going back to the 14th and then down, but held. So we kind of came down, filled the gap here. Right there, you can see. But we have a descending triangle, so that's something that we have to really pay attention to. It's a small one, but I don't need to rehash that, do I, on Elliott's views on the small triangles. So I think you hang in there on this one too and see, can it break to the upside from this triangle at the 480 level? Ignore that it's in a wave 3. You know what we've talked about, triangles trump everything. You can't look at that and say, well, it's in a wave 3, it's going to break higher. It might not. But I think the key here is, can it hold 480? If it does, all right, we're set up to run to 600. But if it breaks 480, I think that's the time to exit that one. And then last week, remember we said if or on love, right? So we had a one-day breakout of this triangle, and we said if there was follow through, you trade to the downside. If it recovered and jumped back up, then you could still go ahead and put a strangle on LUV. And so let's see what happened the next day. Little bit of follow through. And so you look at that, it's kind of holding here around 33 in this area. But this should be, if you follow the guidelines of what we said, a downside trade. And if we can break 33, we really have something going to the downside. If we do break above this 10-day moving average and get back above 34, we got a little dragonfly doji there, but if we can get back above it, then maybe we can do something back to the upside. But I think 33 is the key here. If it breaks that, the short position is great. If it holds and moves back, then we have to look at, is this just a massive triangle being built here rather than the smaller one? And that is a possibility, but we're not there yet. So a lot has to happen before we start looking at that, mainly holding exactly where we are here and running up towards 36. That's what would need to happen if we are building a larger triangle, and it's just the construction of the triangle isn't done yet. If we look at the ADX, this would lead you to believe that the triangle is done because the ADX is moving significantly back higher. Usually when you're forming a bigger triangle, you might get a little bit of a blip in the ADX, but not a move like that. So it does feel like perhaps the triangle part of this is over, and we're just finding a little bit of support here around 33, and maybe we break down below that. We'll watch that, but I just wanted to clarify that because we left that as an if or last week. All right, so let's see what we can find this week and get to some questions before my soapbox takes up all of our Q&A time tonight. So there is one impulse, and that's on IMXI. Hey, it doesn't really look bad, doesn't International Money Express? Not super familiar with that. Don't even know what the options might look like there. So let's see if there's even options there. IMXI on the NASDAQ before we go any further to see if it's even worth it. Yeah, I kind of felt that was going to be it. Not a whole lot of choices. Some width there in the spreads. Yeah, that's too wide. Yeah, we have to let that one go. So forget that. Lots of consolidating stocks. Gosh, I would really like to see the VIX get back down to 18. I'm really itching to put some more strangles on for our subscribers. But with the VIX inching down and the market kind of moving down, not the ideal time for putting on strangles, because you don't want the market to slowly break lower and then the VIX come down. But perhaps in the next day or two, we're able to send a few out. Let's see if we can find one that might be worth. There's good old Target. Let's see what that one looks like. I think this is probably the best area to be. Look how low that ADX is. See, the issue that we have here is it's bouncing around. It does move, but is that enough? You know, it from 140 to 170, 30 points, you can clearly see that we're more of a trading range. So these are more flats than they are triangles. We did dip down below that 150 level there in December, but quickly got back above it and then ran up to 180. I don't know. I feel like there's not quite enough move there. Maybe there is, but perhaps not quite enough. FFIV is one we've done many times in the past. There's that M phase. A lot of you ask about that. Maybe we can take a look at that one, but this looks pretty interesting to me here. Look, I mean, just goodness, look, the 8. Yeah, this is going to be what we're going to look at here. You can see this huge descending triangle, kind of a vertical. That's a pretty vertical upper trend line, the lower highs. Give it a little bit more perspective there. But look where, I mean, all the way up to 160. So we have 20 points, which is more than 10%. And the ADX at 8 means that this is likely to break out really soon, sooner rather than later. So I did kind of want to stay more in the triangle range anyway, with the market trying to figure out where it wants to go. So that's what we're going to do here. So for tonight, 228, it's going to be FFIV in a strangle. So that's our case study for tonight. So we've got downside on LUV, and then we have a strangle on FFIV. So that updates us on the past 2 weeks, and then what we looked at on the the other markets. So there we go. Few minutes left. So Zach, I'll take as many questions as I can in the time we have allotted.
Yeah, that sounds great. I'll pass through as many as possible. Thank you for an interesting presentation as always. And we'll go ahead and get cracking on these questions. So we'll start out here with the first one from Don via Zoom. Please, can you explain the difference between Elliott wave and Elliott wave long in relation to Newcrest mining, which is NCM on the ASX?
NCM on the ASX, because it comes up here on the Toronto Exchange.
That's what it's listed. It says ASX NCM.
Yep, it's on the Aussie market too, so it's on both of them. We look at the Elliott wave count. So the Elliott wave long count takes longer counts into play in the algorithm. Often the charts are almost identical, but periodically you get something a little bit different. So I'm going to take that off. So there's the Elliott wave long count. And then I'll put the other one back on. So we're at what, 22.5 with a 45% extension. Okay, yeah, so completely different chart. So we had a wave 4 correction here at 36. There's a lot of the hardcore Elliotticians that when they see a difference like this, they tend to give the nod to the Elliott wave long count. Completely different patterns here, as you can see, which would make this super confusing. So we've got here a 5 wave to the downside pattern on the long range count. And then if we go back to this, we've got a 5 wave pattern to the upside. Even though it's not a triangle, you can make an argument that ADX is too high. If we had a really low ADX, you could say, well, let's just put a strangle on and let it play out and see which one wins. But I will tell you that most of the hardcore Elliott wave folks would pay more attention to what's going on here on the long range count. Just it's in the algorithm, takes more data, longer data into account, and you look at that and say that with a 45% wave 4 correction and a move down to fill those gaps, there's potential for continued move lower. If it's going to hold, it's going to do it right here, because you can see 3 days in a row right on the 50-day moving average. So, but that would make me nervous trading to the upside with that Elliott wave long count, unless we can turn from this 50-day moving average and take out this previous 4. So I would have trouble doing anything with this right now with not a clear picture between those two counts. But what a great question.
Agreed. Yeah, that was interesting to look at there. Next up, we're going to go over to Chris from YouTube. Rob, if able, would you look at NVIDIA for me? I'm short. Maybe a fan.
Is that for real? Is that from a viewer? Or is that from you, Zach?
Oh, it is. Chris just has a great question here. If you look at NVIDIA for me, I'm short with 310, 230, 225 PDS, which seems to be paying off nicely post-market. I'm looking for gap fill to downside. Yeah,
I don't know what happened. I wasn't looking to see. I had other things that I was looking at, but I do have NVIDIA is on my screen. And earlier in the day, it looked good. And then, as you probably saw intraday, right at 2 o'clock, boom. After being up on the day, it made a decided move to the downside. And so we went down to right around 231 at the close. And as you're right, it's down $3 or more in after hours as well. So I'm not completely sure if something came out news-wise to turn that around, or if it was just an institution that was taking some gains, which certainly happens from time to time. See if I can find any news real quick here on what happened with NVIDIA at 2 o'clock, because that was the moment of truth. Okay, Yeah, they're raising more money. So so what happens when they do this is it dilutes the float. That's why I move lower. So there's your news.
Might have mentioned AI a bit too much in their conference as well. I don't know if you caught that one or not, but I'll have to send it over to you.
Okay. Well, the news that came out at 2 o'clock was it was exposed that they filed for another $10 billion in mixed securities. So that's going to dilute the float. They've got something in mind. Is that for the AI? Is that what you're talking about, Zach? They're going to whatever they're raising money to do something, and so that that diluted the float a bit. But look, from a technical standpoint on the chart, is this the person that asked about it last week if it was a short? And I believe I said that I would be cautious on shorting this. So the person that asked this may end up being right. And that was certainly helpful. And I don't know that that is something that we usually turn and bounce back from. In other words, diluting the float. So that usually takes a bit of time for the market to digest that. So I would say you're probably on the right side of this one as far as it coming down rather than going back up in the near future. And do we come all the way down and fill this gap? I don't know if we get that far, but we might. That's the kind of news that could spur that on. But at least back down to the 10-day moving average. So yeah, good on you for following through with that. I would have been a bit nervous on that, but you got a news event that helped. And so, yeah, good job.
Agreed. And I see we're 2 minutes till 10. You want to maybe go till 10:05 tonight since we started a little late due to some technical difficulties.
Okay.
If not,
That's fine. That's fine.
No, you are a busy man. So we'll go over to another good question here. 1 second, just getting back up to it. Hold, please.
So good you can't remember it, huh?
Well, it's just a matter of getting to it. I got a lot of screens and windows up here. Isaac, I got a question for Rob. Is it Katie bar the door time for Honeywell?
Let's take a look. Yeah, Katie is bolting that door. Yeah. Now let's see what happens tomorrow with that doji today. See if you can get any kind of a bounce back to the 10-day moving average. There is a little bit of support here at 190. I think I'll hedge that a little bit by saying if we break 190, yeah, it's 170. 170 is in the cards. And even a bounce here could very well be short-lived. That seems to be a pretty significant march to the downside, and that's the kind of volume where people are leaving. So in other words, when I say people, I'm talking about institutions, etc. So I'm going to give Katie the 190 level before she fully bars the door. But yeah, she's looking at shutting it and putting the bolt on it. So
thanks, Rob. Next up, we'll go over to William from YouTube. Would like to look at ENPH.
Yeah, we almost looked at that one in the strangles. So we should be seeing a bit of some sort of consolidation here because it's in the list, and that's what's going on. Is it has a bit of a descending triangle. So that wave 4 is at 80%. Is that 80%? So yeah, so that's disqualified. So turn that off, and then let's turn these off so we can see it. That's 42%. What? Oh, I still had the long range count on. That's why. It's like, what? So there's the 80%. So yeah, so this is disqualified. And we look at pretty good support there at 200. And there's your descending triangle. That's why it was showing up on our, it's probably too expensive to do a strangle and stay within the risk parameters that we use. But if you had a larger account, that definitely looks like a really good setup for a strangle. If it breaks to the upside, it's got nothing in the way until it hits 240. And if it break above 240, it's going all the way back to 300. And if it can't hold 200, it's a little trickier on the way down, isn't it? There's some support at 180 and then more support at 160. So it would have to deal with that potential support at 180 before you could get a further move lower down to 160. Something's going to happen with it. I know that's not what you want to hear. You want a forecast of direction, but the bottom line is it's in a state where it could go either direction. And I just don't pick, when you have a triangle, a well-formed triangle like that, I don't pick a direction. I can just tell you it's going to make a pretty significant move. And what I mean by it's like a 60-point move one way or the other is coming. It has a doji today. Could that start tomorrow? There is a little room here where it could play around for a few more sideways days and move into the point. I used to talk about this when I was doing live seminars all the time, but the biggest mistake that I made in my early days of trading strangles on these triangles was I would see a triangle like that and I would say, just a couple more days. Let's let it go sideways, just a couple more days, and then it'll be in the point of the triangle, and that'll be a perfect entry. But when you see these that are that well set up, it doesn't always go right to the point. It could break out tomorrow. And so I learned that when you see one that's well set up, if you put it on and you have a few sideways days before the breakout, that's better than missing the breakout completely, which happened to me enough times to where I stopped doing that and stopped trying to have the absolute perfect pattern. It's pretty good now. And so, again, I can't tell you which way this is going. And the thing to do is, if you don't want to put on a strangle, let it make the break. Give it a break below 200 with a follow-through day, or above this upper trend line with a follow-through day, and then trade it directionally on whichever way it goes. That's the best way to do it if you don't want to put a strangle on it, because it would be expensive. But yeah, it's definitely going to move.
Couple of symbols for you from Eric here. Hello, Rob. Thank you for your time. Could you please review DJT, which is the Dow Jones Transportation, and then also MRTN, which is Martin Transport after. I think if you just click search, it should.
Yeah, it's not giving me a market. So
yeah, well,
something I think else for the transports, because
right
I've
now
looked at it before. I'm not remembering the symbol offhand. There's something other than DJT that that shows the transports. That's a good one to look at, because a lot of people with Dow theory believe that as the transports go, leads the market. But perhaps we'll have to look at that next week. Give me time. I don't want to use the remaining time here searching for it, but
it should be on DJX and it's symbol DJT.
Well, it would show up here if it was, but let's see. Yeah, see, we don't have DJX, so
okay, no worries. We'll figure that out here in a bit. But next one is MRTN.
I'll look it up real quick. What's the other one you want to look at?
MRTN. Which is on the NAS.
Yep. So holding in there right at 22 and awfully close to a 38% wave forward correction, not quite there. You don't want it to go down there, because if it does, that means it gives up 21. And if it gives up 21, it's coming down to 20, but it's trying really hard to hold this level here at 22. If it can do that, then we can turn and head back to the upside. So this one's fairly easy. If it can hold 22, then it's going back to 23 because there's nothing in the way, and that's resistance. So it should easily get up to 23. If it can't hold 22, it's going to tap the 50-day moving average on the way down to 21. And if it can't hold that, then it's coming down to 20. This one's just $1 increments all the way around. But it's done a pretty good job over the past 2 weeks of holding here at 22. So I would say that there's a chance that you want to get back above the 10-day moving average, but that's the key here. Just watch these dollar increments. If we can get back up to 23 and you break above that, you're off and running. But if it breaks 22, it will go to 21 rather quickly. And if it breaks 21, it'll go to 20 rather quickly. So if you're long this, then you want it to hold this. And if you're short, then I would say let it break 22 and then go short.
All righty. Thanks, Rob. You got time for one more?
Yeah, let's do one more.
One more. All right. At random, we will go with. Let's go with coin.
Oh, okay. Lots of chatter about that on the financial networks lately. With this big move to the upside, everybody was all excited again. Now it's come down and kind of consolidated a bit. Positive, nice bounce back, holding the 60 level, which it was really key. It really needed to do that. And I would say that if I take all this other stuff off, that's a pretty decent descending triangle that we broke out of today. But as you know, you need a follow through day. So if we can close, you would like to see it exceed today's high. But even if it doesn't do that, if we get a higher close tomorrow, then we're likely coming back up here. It probably just got too vertical going up to 80 before, so it needed to come down and regroup. We've talked about that before with these vertical moves. That's one of my things. Something goes vertically up, often comes vertically back down. Perfect example right here with coin. But it really looks like it wants to hold this 60 level. And if you get some sort of bullishness tomorrow, I think we're back at 80. And then we'll see where we can go from here. But if you wanted to take a speculative shot, barring anything extraordinarily negative tomorrow in the morning, I think you could throw a speculative long trade on that with a move back to 80 and then regroup and see what happens from there. Thanks, everybody. As always, we very much appreciate you spending some of your valuable time with us, and we hope you enjoyed that, found it valuable, informative, and educational. We do our best to try to make that a good positive use of your time. So have a great rest of your week, and look forward to talking to you again next week.